Okay, so the fourth question, P5-25, balance sheet consolidation of majority owned subsidiary. So on January 2nd, 2008, Total Corporation acquired 75% of Tiken Tai Company's outstanding common stock. In exchange for Tiken Tai stock, Total issued bonds payable with par value of 500,000 and a fair value of 510,000 directly to the selling stockholders of Tiken Tai. At that date, the fair value of NCI was 170. So the two companies continued to operate as separate entities subsequent to the combination. So we are given the assets, liabilities, and stockholders' equity data of Total and Tiken Tai. Okay. At the day of combination, Tiken Tai owed Total 6,000 plus accrued interest of 500 on a short-term note. Both companies have properly recorded these amounts. So A, we are asked to record the business combination on the books of Total Corporation, and then present engineer journal form all elimination entries needed to prepare the consolidated balance sheet at the acquisition date. And then C, we are asked to do the worksheet. Okay, and D, we are asked to make the consolidated balance sheet. Okay, so just like the way you do for the differential and also for the consolidation of less than wholly owned. So we will start with the consideration given by Total 510. Okay, why 510? Because the bonds payable issued by Total had a fair value of 510. So we use the fair value instead of the par value. Okay, so remember, we will always use the fair value. Okay, 510, and then the fair value of the NCI is 170. So the total consideration is 680. Okay, then we minus the book value. So the book value will consist of the common stock, additional paid capital, and retained earnings. So 200,000, 130, and 148. So if you sum it, the book value is $478,000. So the difference here is 202,000. After that, we can calculate the goodwill. So the goodwill will be differential minus the excess of net identifiable assets. So we need to go back to the balance sheet of Tiken Tai, okay, to see which accounts that have a fair value amount different from the book value. Okay, so cash will be the same. Receivables, remember that the receivables fair value is 30,000. So in order to compare with the book value, the receivable must minus the allowance for bad debt. So 31,000 minus 1,000 will be 30,000 also. So there's no excess. Okay, for inventory, 68 becomes 72. So the excess is 4,000. And then land, 50,000 for book values, 70,000 for fair value. So the excess is 20,000. And then buildings and equipment also. So before you compare to the fair value, okay, you need to calculate the book value first by using the historical cost minus the accumulated depreciation. So if you minus it, it will become 450,000. So 450, and then the fair value is 500, so the excess is 50. Okay, and then pattern, okay, from 0 to 40,000, so just directly 40,000. Okay, for the liabilities also the same, so there's no more excess. Yeah, so if you minus all of the excess, you will get the goodwill of 88,000. And then we can go to A. Okay, so we need to record the journal entries of the business combination. So just debit investment in Tiken Tai, 510, and then credit bonds payable 500,000. So if you notice that the fair value is 510, and then the par value is 500,000, so there's an excess of 10,000. That's called as bonds premium. Okay, so that's for A. Then we go to B. Yeah, it is about elimination entries. So it's at acquisition date, so it's only basic elimination entry, differential reclassification entry. So if you want to do the calculation first, it's okay. If you can do it without the calculation, then you can do it directly. Okay, so debit common stock, debit additional paying capital, debit retained earnings, and then credit investment in taken time, credit NCI and NA of taken time. Okay, just sum all of it and then times 75% for the investment in taken time. Okay, and then the NCI in NA is just 25% times the total of common stock, additional paying capital, and retained earnings. And then the differential reclassification entry, you just debit all of the assets of net identifiable assets, which is inventory, land, buildings and equipment, patent and goodwill, okay, with their with their assets value, okay. And then credit investment in taken time, credit in NCI and A of taken time, just take 75% times the total of the differential, okay. And then for the NCI and NA, just 25% times the total of the differential. Remember that taken time owed total 6,000 plus accrued interest of 500 on a short-term note, which is payable for taken time and a receivable for total. Okay, so remember when we learned in chapter 4, for the last part, which is the intercompany payables and receivables, if there is any intercompany receivables and payables that has not been settled yet between the two companies, so we need to eliminate it in the elimination entry. Okay, so you just eliminate it, the payable by debit current payable, and then you eliminate the receivables by credit receivables, 6,500, which is the total of the note plus the interest. Okay, and then we have the optional accumulated depreciation, which is 220. And then C, we can directly go to the worksheet. So just like the way you do usually, you list down all the assets and the liabilities and stockholders' equity. Okay, so before you move to the elimination entry, make sure you are having a balanced amount of total assets and total liabilities and stockholders' equity. Okay, so and then you can go back to your elimination entry one by one. Okay, so from basic elimination entry, you debit common stock, additional paying capital, retained earnings, and then credit investment in taken time and NCI and A. And then the differential reclassification entry, you put all of the assets from inventory, land, buildings and equipment, patent, and goodwill. And then you credit investment in taken time. So remember to make it into two rows so that you can differentiate the number is from which elimination entries. And then you also credit NCI and A of taken time. Okay, and then the intercompany receivable and payable. Okay, so credit the receivable, you debit the current payables. And then the accumulated depreciation entry. Okay, so you debit accumulated depreciation, you credit buildings and equipment. After that, you do the consolidated column. So before that, you sum first the debit credit column to make sure it is balanced. And then the consolidated column, you just sum from total and taken time. Okay, so for assets, if there is an entry or amount on credit side, you need to minus. Okay, remember. Then for allowance for bad debts, you just sum it. Okay, and then inventory, if it's on debit side, and then you sum it. Okay, similar with land, then buildings and equipment, sum the debit minus the credit. And then for accumulated depreciation, like the way you do usually, you sum it, and then if you want to minus the amount, you need to plus it. Okay, then patent, then investment must be 0, and then goodwill. Okay, and then we go to current payables. Yeah, so the current payables, you need to minus it. Okay, so you sum it and then you minus 6,500. Then bonds payable will be the same, and then bonds premium, common stock, minus the debit side, additional paid-in capital also, and retained earnings, and then NCI and NA, you sum both of them become 170,000. Okay, so if the total asset is already equals to the total liability and stockholders' equity, then it is that. And then D, we have to make the consolidated balance sheet. So basically, we just move whatever from the worksheet into the consolidated balance sheet. Okay, So if you want to do the T format or the list del format, it is okay for both of the format. Okay, as long as the total is the same. Okay, so that's all for P5-29.